if you are into the higher tax bracket, it is better to be, to have all the liberty. Even the direct plans, they cost money. NPS comes by far is the cheapest of all. This asset rebalancing on an annual basis itself will provide you some extra return.
Hello and welcome. You're watching Investors Hangout, a weekly interaction to help you learn and understand savings and investment issues, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now it's that time of the year when most of us are looking for investment avenues, probably to save some tax or just planning our investments for the coming year. And even after the new tax regime, one option is the national pension scheme. That's the only option that can help us save some tax in the new tax regime. So if you want to know anything about the national pension scheme, watch today's episode. We'll decode it for you today.
NPS is the national pension system. It came about to solve a particular problem which the government was facing. All the government employees, whether they be central government employees or state government employees, their key entitlement was getting inflation adjusted pension. So it was there was no contribution or there was no funding of this pension plan. But if you got into the government and when you retired, you were assured of this pension for your life. And this was turning out to be a huge liability for the government. So government wanted to put a stop to this. And they did put a stop to this by introducing the national pension system. The national pension system was announced in 2003 and was effective for all government employees who came on board. It is a defined contribution system. 10% of your salary is deducted and deposited in this national pension system account, and 10% is matched by the government. And this 10% has now gone up to about 14% few years back for central government employees. Helped by the government, matched by the government, a self-funded pension system whereby the money will be accumulated till you retire, and once you retire, you will be entitled to receive 60% of your accumulation. At least 40% must be converted into annuity, and that will support your pension. Now it is available to everyone. Besides that, many variants of this came about, which was Swavalamban scheme, and nowadays what is being popularly called as Atal Pension Yojana. Broadly, there are two plans in NPS, which is active choice, and the other one is auto choice. The auto choice comes in three formats. One is an aggressive one. The basic principle of auto choice is that as you get older, your allocation to equity comes down. The aggressive allocation plan can have up to 75% allocation in equity, and it is available only for people under 35. But here also, it will keep declining as you get older. The other one is, moderate life cycle, where the maximum investment into equity will be about 50%, and conservative, where the maximum investment into equity will be 25%. So it is meant for people with different risk tolerance. And the active choice is fairly straightforward. You can choose your allocation yourself, and you can keep it constant. The maximum that you can invest in equity is 75%. Have your equity allocation as much as possible. And only when you get closer to your retirement, start reducing it a little bit, not much. There are 3-4 outstanding things about NPS, the National Pension System. One is that it is the only investment avenue in which your employer can contribute and it will not be added to your income. So this is the only window of tax exempt income that you can derive. So if your employer is actually putting 10% with some ceiling, but 10% of your basic annual salary into NPS, it is treated as an expense for the employer, and it is not considered as an income for you. So this is a great feature. This is a great benefit of if your employer is putting money in NPS. Second is that lowest possible expense, lowest possible cost for any managed investment. Mutual funds, they cost money. Even though there are cheaper options, but even the direct plans, they cost money. NPS comes by far is the cheapest of all. The cost of asset management in NPS is 0.09%. It will be perhaps the lowest in the world, and because NPS has been able to achieve a large scale, then I think one interesting feature is automatic rebalancing. When I'm saying that the active plan can have 75% into equity and 25% into fixed income, there is an automatic rebalancing. This asset rebalancing on an annual basis itself will provide you some extra return. That apart, if you have to do this annually, it is not a very difficult thing to do, but it becomes very cumbersome thing to do. You have to keep an eye on an asset allocation and then go about making that change, whether to sell equity or fixed income and invest in the other asset, and in what quantity. You have options to choose a fund manager within NPS. And if you don't like a fund, if a fund stops doing well, you change your mind, you want to move your money from one fund to another, there is absolutely no tax implication. You can move your money from one fund to another, from equity to debt, from debt to equity, without any tax implication resulting from this action. When I look at the tier 1 of the equity fund in NPS and compare it with the most comparable category of mutual fund will be the large cap fund, over longer period of time the NPS funds have plans have done little better, but nothing significant, 1 or 2 percentage point better. And in recent times the large cap funds look better. So everything else being equal, lower cost will translate into superior performance. The performance of an active fund or performance of an index fund is entirely a function of the market, but everything else being equal, lower cost will translate into superior return. Assuming that the cost of a direct plan in a mutual fund will cost about anywhere between 60 to 80 basis point, and the cost of the NPS is going to be 0.09%. This will translate into something meaningful over the next 15, 20, 25 years. Assuming that they are matching the returns of the index, still you will do better off. On the performance front, it will do well. Likewise, in the fixed income, in the bond fund category, the NPS tier 1 corporate debt plan that have given little better than the corporate bond funds in the mutual fund, and this also, the difference can clearly be attributed to their long-term orientation as well as the lower cost. If you are going to choose the new tax regime, if you are into the higher tax bracket, it is better to be to have all the liberty. Plan your investment, don't be guided by tax, and choose a good mutual fund, build your equity portfolio if you have time, and as you get closer, plan your things well. And manage it yourself actively or through mutual fund. But if you have the option, if your employer is willing to contribute to NPS, and that will be a tax-free income for you, sheltered till your retirement, and that is the case where you should go for NPS. If it is profitable for you, or if it is good for you to be in the old regime, then for NPS you get an extra 50,000 rupees concession or tax deduction for extra 50,000 investment here. That's a deductible income under section 80cc(d). So one should be guided primarily by the benefit that you derive. Otherwise, when it comes to investment, I always suggest derive all your freedom, and that can be had in a mutual fund. But if you are getting these special benefit that your employer is putting, go for NPS.
Well, that's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.